Okay, so minimum wage mandates are often touted as a way to support segments of the population that are earning low wages. And in economics, we're able to do an analysis that fully looks at who gains, who loses, and how society is altered as a result of a minimum wage. We're going to do this using a model called a price floor. Price floors mandate a high price for a particular item, and it's mandated by the government. And the first question we have to ask is whether or not this price mandate actually impacts the marketplace. So if you're living in a world where wages are already entry-level wages at places like Walmart, or McDonald's are already hovering around $20 an hour, then you are not going to be affected by a state mandated minimum wage of say $15 an hour. It's not what's called binding, and that's because the true market price is greater than the mandate. But in many places, minimum wages are binding, meaning it sets a price mandate that's greater than the free market wage rate that would exist in the labor market. And so we're going to analyze this using a supply and demand diagram. What's really hard is we have to think about consumers of labor. Those are actually the firms buying the labor. I always have to think twice about that. And then supply is the workers. It's the workers who are the suppliers in the labor market. So instead of price, we're going to just call it like it is. It's the wage rate. And these are the number of jobs. And under a free market world, producers would choose to employ Q star at a wage rate of P star. But when we create a binding minimum wage, what happens is that we draw this kind of like wall or line above the free market wage rate. And that line does some things. One of the things it does is it tells firms to use a lot less labor than they were using before. When wages are really high, firms want to use less labor and more capital. And we learned that throughout firm theory. And so the amount of labor that firms buy is QD. But when the wage is really high, a lot of us might be enticed to work more hours or enter the labor market, say at a younger age or while we also are in college, whereas before maybe the wage rate didn't entice us to spend our weekends away from the ski slopes and behind a counter at McDonald's. So the number of people who want a job is QS, and that leads to a shortage of jobs. Now, if you were in macroeconomics, you would say the difference between the people who want a job and the people who actually get a job would be called unemployment. Now, why is it that so few people get a job? Well, remember from our last video, when two parties, suppliers and demanders, disagree with how much to trade, whoever wants to trade the least wins. That's because nobody's forcing firms to use a certain number of laborers. Once they buy up QD labor, they're not buying anymore at that high wage rate. Now, so that means that it used to be that Q star was the number of people who had jobs, and now it's only QD. So in microeconomics, we like to add another layer to this analysis where we say, look, these are the number of people who lost their job because of a government program that mandated a minimum wage above the market price. And so these are, let's just call out, these are the people who lost their jobs. A little bit different than what you would see in macroeconomics. So the question is, do these people who get a job actually get that high minimum wage? Because maybe the gains to the winners might outweigh the losses. And to do that analysis, we have to look at what happens when there's not enough jobs and a lot of people competing for the limited number of jobs. So jobs are scarce in this world. And so at that high price, a bunch of people start queuing up for jobs. And they are willing to expend energy to get the limited number of jobs. How much energy they're willing to expend depends on the number of people lining up, the shortage. And so what happens is all those ways we compete for the limited number of jobs starts going into the true cost to get this job, which drives the real wage rate down. Okay, boom, boom, boom. If I had to stand in line or do 300 applications in order to find a job, or if I had to get a special certification in order to outcompete all the other people standing in line, that goes into the true compensation I get. Okay, so that starts to bid down the wage rate. How far must I go to outcompete all my neighbors? I have to compete until I have no more incentive to do so, until that wall of QD intersects and the wage gets intersects supply and the wage gets low enough that I'm no longer willing to compete. So what do these competitive activities look like? Well, sometimes a common practice is that firms now require you to cover the cost of your uniforms, whereas before wage rates became more prevalent, it was common practice for uniforms to be paid for by the firm. It's also common practice that people compete based on education. So if it took you 3 years of college to compete for an entry-level job at Walmart, those 3 years of college go into the effective wage rate. Sometimes it's like literally standing in line to submit your job application or going to a bunch of job fairs or applying to a lot of places. And so all of those competitive activities are costly to the laborer. Those workers then consider that when they're considering their real compensation. So what happens in aggregate? Well, under a free market circumstance, firms, the consumers in this marketplace, they pay P star for their labor. They have a marginal value for that labor all the way up to the demand function. So they get A, B, and D. That's here. Now, laborers receive a wage rate of P star out to the quantity traded, down to the marginal cost, C, E, and F. That's here. Taxpayers aren't involved in this scenario. This is just mandating a price. Let's see what happens when that price floor is introduced, or that minimum wage. So now, when we're talking about, firms, the consumer, the price that they have to pay goes all the way up to the mandated minimum wage, out to the new quantity, reduced to QD, up to the marginal value. That's area A. Now producers, that's the laborers, they have to compete in all the ways that we spoke about. So their real wage rate goes all the way down here, real wage rate, you say that 10 times fast, out to the quantity demanded, down to the marginal cost. They only get area F. So deadweight loss is actually really big in this scenario. So let's break this down. So first we have deadweight loss of this triangle here, D, E, and F. In this scenario, what we see is that there's a reduction in the number of laborers being used in the marketplace. And these were valuable laborers whose marginal value outweighed the marginal cost, and so they would have been employed under a free market circumstance. They're not under this minimum wage scenario. And B and C are a little trickier, just like in the scenario when we looked at rent controls. B and C are lost if the way in which people compete for the limited number of jobs is through standing in line, applying to a lot of different jobs, investing in over education for the skills needed for that job. In that case, B and C are absolutely lost. Sometimes firms can recoup portions of B and C. The scenarios we can think about are things like forcing your laborers to pay for their own uniforms. Walmart got into big trouble because they were found to be forcing employees to show up to work before they clocked in and work a certain number of hours prior to officially clocking in, thereby effectively reducing the wage rate. If you weren't willing to do that, you weren't able to compete away the competition. So B and C are sometimes recouped by firms, sometimes not. So, what's really important is to look at how much is lost as a result of minimum wage. But the question is, did the people we want to get these jobs at a higher wage rate actually get these jobs? Well, the data suggests overwhelmingly no, because the way in which people compete for these limited number of jobs tends to be through overeducation, overcertification, and lots of time investment. What we often see is that those who are being competed out of this marketplace tend to be those that we were hoping to receive a higher wage rate, the undereducated, for instance. What's also true is we've seen teen unemployment rates skyrocket, and that has correlated directly to rising minimum wage rates. And that's because teenagers are less adept at competing away the competition. They have less education, and they have less experience. And so as a result, they're really not in a place to do a good job of competing away the competition. College students are much more able. New grads are much more able. Now, does this matter? Well, it turns out it does. There's a correlation between working as a teen and lifetime earnings. We think some of why that happens is because we have exposure to the workforce many years prior to our first real job, and this helps us understand customer service and professionalism. It helps us understand time management. For any of you who ever worked as a teen and are now farther along in your career, you know the value that brought to the table as you entered your first job. It wasn't your first time filling out HR forms, for instance, and all of that gave you an edge or a competitive advantage when you entered the marketplace. So it does have long-term implications. It might be one of the reasons why we're seeing some folks who are graduating in the last 10 years who experienced the lower employment rates as a teen, struggling with those first jobs, the HR side, the soft skills side. It may be in part linked to this minimum wage story. So very interesting analysis of the impact of minimum wages and what we can expect occurs in the marketplace. The pie is much smaller as a result of these types of prices.